What's up, y'all? Today I'm going to walk you through 7 metrics that I think every business owner needs to track in their business in order to get a handle on what's going on in your business and be able to make the best decisions that you can as a CEO, which I think is really important going into 2025. I think the political, social, cultural environment we're in, on top of AI coming onto the scene, on top of all the changes we're seeing with social media platforms, I think that successful business owners, successful CEOs are going to be the ones who are able to pivot quickly. And you're only going to be able to pivot quickly if you are monitoring your business, if you're keeping your finger on the pulse of what's going on, and tracking these metrics is going to be the thing that helps you to do that. So I'm actually seeing a lot of our CFO clients who are asking more about metrics lately. And part of it, I think, is maybe they're seeing the importance of them. I feel like sometimes as someone who provides advisory support to businesses and having the reporting background that I have. So before I started my business, I worked in Big Four as an auditor, and then I worked in a corporate accounting finance department and worked my way up the ladder. And one of the things that I was responsible for was SEC reporting, and we also did internal reporting. So reporting, I think, to me was always really, really important. And so I feel like I've taken that into Young & Co. and into the High Profit Society and really everything I do. And sometimes I feel like I'm shoving it down people's throat a little bit. I think that I love reporting, maybe love is a stretch, but I really like reporting. I get more excited about it than a lot of other people do, but that is because I see the overall importance of keeping track of what's happening. I just could not manage my business the way that I do if I didn't keep track of my own metrics. So what I'm going to do here is walk you through 7 metrics that I think you need to be tracking and how to calculate them. I'm also going to give you a little story of how I used my metrics, tracking them in really the back half of 2024 in order to make some of the decisions that I've made in terms of what I'm going to focus on in 2025. So you kind of see a real life example of how to use metrics. So the first metric that I think we all need to track is obviously sales. And one of the things I see most people doing with sales when I look at P&Ls is they have one line item for sales. They don't break out sales by offer. They don't really understand where all their cash flow is coming. Meanwhile, they'll have like 1,000 accounts for expenses that they're tracking and one line for sales. I actually think that is so backwards, right? So when I look at sales, what I like to see is broken down by offer or by service line. So you know where your cash flow is coming from. I like to be able to track how much MRR do you have every single month. I also like to be able to track in my sales metrics, maybe not on the face of the P&L, but I like to know out of your sales, if you don't have like a retainer or MRR, I like to know how many of your clients are new versus returning. I also like to be able to calculate the average price per customer when I look at sales numbers. And then I also like to track conversion rates. So again, those might not be on the face of the P&L, but they're related to sales in terms of what I like to track when I think about sales. So for your conversion rate, I like to know how many calls did you book and how many calls did you close? Or if you use a sales page, how many views did you have versus how many closed, stuff like that. So we have a sense of your conversion rate numbers because that's going to help you when you go to figure out how your marketing's doing, right? The other metric I think that is almost probably equally as important as sales is gross profit. So gross profit over here in blue, you can see I wrote down is sales minus cost of sales. Cost of sales is the cost of delivering the service. So for example, for our CFO offer, I have to pay my team members to do the accounting, to do the client meetings, to do the tax work, to do the forecast, to do all the things that we do. The cost of what I pay my team goes into cost of sales, and then gross profit is what I have left over after I pay my team to do that work. The reason this is important is because theoretically, every time you make a sale, you're going to have to pay for the work to get done. Or if you had a product-based business, you'd have to buy the product that you then turn around and sell. And it's really important to know how much of that sales price are you keeping after you pay for the thing that you are selling. I also like to track gross profit margin, which is just the percentage of gross profit divided by sales. And I've talked in other videos and in other episodes about target percentages, but generally this would need to be bare minimum 50% for most businesses, if not upwards of 65, 70, 80%, depending on the industry and the way you've structured your offers. Another metric I think is really, really important, and this is actually one that I use to help me make really key decisions about what to focus on in 2025, is lifetime value, or LTV. This is one I actually don't see a lot of people tracking. And it's really important because what this tells you is how much is a customer worth. So basically, when a customer comes in, how much are they going to pay you over the time that they spend with you as a customer, right? Tracking this is going to help you scale your business, because if you can see, okay, let's say a customer is worth $10,000 on average based on how much they spend with us over the lifetime that they spend with our business. If a customer is $10,000 in terms of lifetime value, then that's going to tell you how much you can afford to spend to acquire that customer, which is one of the key things that you want to have in mind as you implement a plan to grow your business. So the way you calculate lifetime value, it's a little bit more complicated than any of the other metrics I'm putting in here, but stay with me. Okay. You can also ask ChatGPT to help you calculate this. Fun fact. You want to go back through and look at your records and see per customer. You basically pull your lifetime sales records, sort by customer, and then add up what they spend with you, right? But you would say, how much is a customer paying me in total across the whole lifespan? And what I put here times the GP percentage is times the gross profit margin, basically. So if you know you're keeping 70% of every sales dollar that comes in your door, I like to take the total the customer pays times that 70% to figure out how much am I actually making after I pay for delivery. I like to track this lifetime value versus just focusing on sales, because I think the amount that you keep after you pay your team is actually what you're going to be able to use to pay your overhead expenses, to put into marketing, to grow your business, to pay yourself, etc. If you have like a retainer type model, so this is the way that I calculate it for our CFO clients, what you can do is back into it using a churn rate. And so the churn rate is down here. So basically what you want to do is go to the beginning of, let's say, last year and say, how many customers did we have in all of our monthly retainer offers? And then you go whatever time period later, maybe it's 12 months later, and you see how many of those starting customers dropped off. So the churn rate is how many dropped off divided by how many you started with. And then to calculate lifetime value, it's kind of the inverse of the churn. Basically, the lifetime value is the inverse of how many people left. So what you're going to do is you're going to say, okay, those customers paid me on average this amount in this time period divided by my churn rate. And that's going to give you your lifetime value. Again, I like to multiply that times gross profit percentage to see how much I'm keeping. I know that for some of you that math may have been a lot, but I promise you this is one, if you put it into ChatGPT and ask it to walk you through the calculation, it will help you to calculate this a ton. I'm going to pause and tell a little story about lifetime value. So one of the things that I decided to focus on in 2025 is really putting an emphasis on bringing on monthly CFO advisory type clients in Young & Co. And then also the High Profit Society, really focusing on those two offers, the High Profit Society being more of a done with you group advisory version of the done for you monthly CFO service that we have at Young & Co. The reason that I decided to do that, after mid 2023, we bought another accounting firm that was more heavy on the tax revenue than on the accounting, strategy revenue, and built up a tax service line under Young & Co., which we still have. But I decided at the end of 2024, really, to pivot more into focusing on the monthly clients. The reason really came down to these two metrics, gross profit and lifetime value. In 2024, it's kind of funny. I never really took the time to do my own financials the way that I like for my clients to have financials, meaning broken down by, sales, by service line, by offer. We did break it down by offer, but I didn't do my full P&L by like our tax business line and our CFO business line and like coaching programs. The cobbler's children have no shoes, right? But I finally took the time to do that in mid to late 2024. And I noticed a couple things. Number one, I noticed our gross profit margin between the business lines was very different. And I also noticed that the lifetime value of our monthly clients is substantially higher than the lifetime value of our tax clients. And that is because the offer structure is very different. And that's because most of our monthly clients have stayed with us for years. Like I think the average that we have when I calculate the churn here was an average of 3.5 years, which is actually right about the time that we even started offering CFO clients as a service, right? So by tracking these metrics, I saw very clearly that out of all of the things that I had done, all of the different service lines that we tried out from 2023 to 2024, that our monthly CFO clients were by far the best clients that we had. And I would say also they were the ones that we provide the best results for, who stay the longest, who are the happiest, who give us the best feedback. All of that led me to say, okay, I kind of knew that in my gut, but seeing it on paper in black and white really just made it super clear for me that in 2025, we need to focus on this offer because it is the best one that we have, and it's the one that we're going to have the best impact. We're going to see the most growth. We're going to have the happiest clients. We're going to have the best results. Like, this is where we need to focus. Okay. And that's what we're doing. Honestly, I would never have known that had I not taken the time to track all these numbers. Like, yes, I would have known it. I kind of had an instinct that said that, but like seeing it in black and white and seeing the financial results of the different service lines that we have just makes it so crystal clear that you really can't argue with it, right? Like, that's why I think data and reporting is so great, and why I think every business owner needs to be tracking these metrics that I'm laying out. Okay, end of story time. The next chunk of metrics I think we need to track are customer acquisition costs. This one may not be applicable to you if you're not actively spending money on marketing, but if you do spend money on marketing, if you run ads campaigns, or let's say you have costs to produce content for social media, then you need to know your customer acquisition cost. And so the way you calculate your customer acquisition cost, or CAC, is you take your marketing spend divided by the number of customers that you acquired, preferably through that marketing channel. So let's say if you have clients that come from ads and you have clients that come from referrals, I want to calculate the customer acquisition cost using the ad spend for the marketing spend here and the number of customers acquired from those ads. Because if you add in the ones you acquired from this channel over here, you're not going to have a clear picture of how much your customer acquisition cost was from your ads campaigns. Okay. The same goes for content. So tracking, like knowing if you're spending money on content creation for different channels, being able to track how many clients actually come to you from those content channels so that you can see like how much am I paying per customer to bring in from these channels is really important. And one of the things that we do, if you calculate your customer acquisition cost, is compare it to your lifetime value. The bigger the discrepancy between lifetime value and customer acquisition cost, the more profitable your business is going to be, the more scalable it's going to be. So I have seen a lot of clients who will be paying X amount for an ads agency and running ads. And when we sit down and we break down their acquisition costs compared to their lifetime value, it's basically breaking even, especially after we calculate the gross profit percentage on that. And so they're basically not making any money, but they feel good because they're generating revenue, but they're not actually generating profit after they pay for customer acquisition costs. And so the decision needs to be made from there to say, okay, how can we either increase lifetime value to get that discrepancy higher? Or how can we reduce customer acquisition costs? Or should we be focusing on other channels where the acquisition cost to lifetime value discrepancy is bigger, and therefore we're going to be more profitable? Okay, the next metric is net profit. So this would be your bottom line. When we work with business owners, I really like to calculate what people call SDE, or seller's discretionary earnings. I know you're probably not selling your business. You could also call this owner discretionary earnings, but it's basically the total profit plus owner compensation. So if you have an S Corp and you have a W-2 salary, you would take that salary plus your bottom line profit. That is the total amount of money that your business is generating that you as the owner have the discretion to spend as you will. This is really one of the key metrics for how businesses are valued. And I like to take that number as a percentage of sales to say, can we hit 30 to 50% of sales as a percentage, like discretionary earnings as a percentage of sales? The higher that number is and the more profitable your business is, again, that's more scalable, higher business value, et cetera, et cetera. The next one I think is important is cash. Particularly when I'm looking at cash, I want to know how much runway do you have in your business. If you did not make any sales today, starting today for the next however many weeks, how long could you keep the lights on? This is one of the most important things I think we need to keep in mind as business owners, because As we saw going back even to COVID times, when things all of a sudden shut down, how many businesses did we see fail, right? Because they didn't have cash in the bank. Or even with like the potential TikTok ban, for example, people freaking out because their primary source of income was going to be shut down. How much cash do they have? Do they have enough runway to give them the time to pivot and go bring on another income source to keep their business running? Then the last metric, in this one, I'm kind of lumping a bunch of metrics into one, but really looking at your leading metrics. So leading metrics are different than most of these things that we've already talked about here. These are lagging metrics. Leading metrics are really measuring the inputs into your processes. So things like lead gen, things like team utilization, typically are the things that you're going to see as predictions of how much income your business is going to make on the back end. And you measure how much money your business makes on the back end, sales, gross profit, all these things. These are your lagging metrics, meaning these happen after the fact. So I think that it's really important to also track leading metrics, aka your inputs, the things that you say, I know if I do X, then I make money. And so these generally can boil down into things like reach on social media, your audience, how many inquiries or calls you're having booked, how many actual client appointments are being booked, how many billable hours your team is recording, things like that help you know, okay, if these things are hitting, my target numbers, then I know that my sales and my profit margins are going to be where I want them to be. All these sound great, but how do you actually track these? I will tell you, I track my metrics in 2 places. Number 1, I tend to track things like my leading metrics in a CEO dashboard, scorecard, whatever you want to call it. It is a really basic Google sheet that I track. One time a week, I go in and I'll pull my relevant metrics in these different buckets and put it in my scorecard. And these are the things that help me know that either me or my team is on track to getting the results that we want to generate. I do not use any sort of like fancy dashboard charts and graphs for this, but if you want my template for a CEO scorecard, you can go grab it for free at the link in the description under this video or under the podcast episode, wherever you're listening. Then I also track all of these financial metrics. So most of my sales, gross profit, and then some of the KPIs like lifetime value or like average price per customer, I'll track on my financial statement. So typically what we do for our CFO clients at Young & Co. is we'll have a one-pager that summarizes their financials, their cash forecast, and then KPIs we track under the P&L. So we can see the P&L by month, including like the key categories that we want to see. And then the calculations for things like utilization percentage or average price per customer or whatever the relevant metrics are, just on the face of the financials. And we put that into a Google sheet. So if you have a bookkeeper, hopefully doing your financials, what you can do is grab your P&L. I like to view the P&L by month, and then you can also add your KPIs just kind of at the bottom of that page and use your numbers from your P&L generally to calculate the different metrics that you want to track that are related to your financials. So I kind of have 2 places that I like to track KPIs depending on what it is, but I really find, especially with keeping up with the CEO scorecard and then tracking my financial metrics on a monthly basis, I find that this really works well for me and for most of our clients too, to be able to keep on top of things that are happening in their business in a timely, relevant way so that they can pivot quickly, so they can make decisions when they see things that indicate that maybe their business is not performing as well, or if they see opportunities, they can take advantage of them faster. But just keeping track of these metrics, I think, is one of the best things that you can do as a business owner in 2025. So before we go, if you're listening to this and you're thinking, I would really love help with either identifying metrics to track or looking at your financials and saying, am I on track? Am I off track? How am I performing compared to other people in my industry? What are my opportunities? What's the next step I need to take to grow my business, to increase my profits, to be able to build wealth? That is what we do in our financial health assessment. So you can also go to the link in the show notes or in the description in YouTube and sign up for a free one-on-one financial health assessment where I will do a deep dive into your overall business and money strategy. That's it for today, y'all. I hope that you enjoyed this episode on metrics, and I'll see you back next week.